There's a debate going around on the internet. Should you invest in the S&P 500 or the Nasdaq 100? Which one is going to give you the best performance? Well, in this video, we're going to let the data do the talking and dive into the historical returns of both. Let's get into it. So what is the S&P 500? The S&P 500 is the 500 stocks made up of multiple sectors that represent the U.S. economy. Now, the Nasdaq has been known as the tech sector, but when you take the top 100 stocks out of the Nasdaq, you come up with what's called the Nasdaq 100, and you'll see which stock or sectors that are missing from the Nasdaq 100. Now, according to Nasdaq.com, the Nasdaq 100 has outperformed the S&P 500 11 out of 14 times in the last calendar year, starting from 2008 all the way up to 2021. But let's take a look at what that specifically means on a percentage basis. So from a numerical standpoint, the Nasdaq 100 has returned 803% total return, while the S&P 500 has returned a mere measly 333%. Now, I'm joking when I say a measly 333% because most people would kill for a 333% return, but that is until they found out they could have gotten an over 800% return by investing in the Nasdaq 100. Now, if we break that down on an annual basis, what this really means is that the S&P 500 returns on annual, based on those time frames, 11% return per year, while the Nasdaq 100 returned about a 17% return a year. So again, 11%, not bad, until you found out you could have gotten 17% return on your investment. Furthermore, what makes the Nasdaq 100 different from the S&P 500? Well, what I want to do is take a look at the industry weightings, which means what industries are in the Nasdaq 100, what industries are in the S&P 500, and then what are their percent weighting. So when you look at 100% weight that makes up all the companies and sectors, we want to look at the breakdown and how they compare to each other. So first up, let's start with technology. So technology in the Nasdaq 100, not surprisingly, makes up 59% of the 100 stocks in the Nasdaq 100. So for simple math, you could just say 59 stocks are all tech stocks in the Nasdaq 100. But when you look at the S&P 500, tech stocks make up a mere 31% weighting of the entire index. Consumer discretionary makes up 21% of the Nasdaq 100, while consumer discretionary makes up about 16% of the S&P 500. As we keep going and look further down, you got healthcare, which makes up 6% of the Nasdaq 100, while healthcare makes up 13% of the S&P 500. So we're starting to see the differences here, where the S&P 500 has more healthcare stocks than the Nasdaq 100. So if healthcare is doing bad, it's going to drag down the S&P 500 more than it would drag down the Nasdaq 100. Industrials, the Nasdaq 100 has about 5% industrials, while the S&P 500 has 12% industrial. So again, if the industrials are doing bad and healthcare is doing bad, it's going to weigh more heavily on the S&P 500 than it is on the Nasdaq 100. But let me say this as well. If tech stocks are doing bad, that's going to weigh very heavily on the Nasdaq, because the Nasdaq 100 is very tech heavy, but tech stocks are usually known for growth stocks. That's usually where you go to get a higher return. And so it's not surprising that even though it's heavily weighted more towards tech, the likelihood that tech is going to be doing bad is a little bit of a smaller chance, because tech continues to evolve and change the world. And usually that comes with bringing revenue, income, cost savings, and things that create growth for your trading account. Telecommunications make up about 5% of the Nasdaq 100, while it makes up just 3% of the S&P 500. Consumer staples, 3% of the Nasdaq 100, 5% of the S&P. Utilities, a whopping 1% in the Nasdaq 100. You don't really think about utility stocks when you think about the Nasdaq. Now, as we look at these next three industries, the Nasdaq 100 doesn't even have these sectors or industries as part of their makeup. So energy, 3%, real estate, 3%, financials make up 10%. Healthcare does bad if the industrials do bad. And then if you look at energy, real estate, and the financials, two of those markets are more heavily weighted in the S&P 500, and then the other three don't even exist in the Nasdaq 100. So you have 5 industries or sectors that could potentially be doing bad that could drag the S&P 500 down, or as you saw, deliver those lower returns. So what does the number say? The numbers say that if you want to get a better return or you want to outperform the S&P 500, then the clear winner is the Nasdaq 100. Now, before we wrap this video up, you may be thinking, you may be in a rush to go off and buy the Nasdaq 100, or maybe you want to go off and buy the S&P 500. But what you'll find is that you can't actually buy the Nasdaq 100 and you can't actually buy the S&P 500. You can't actually buy these indexes. So what companies have done were create ETF, exchange traded funds, that mirror the S&P 500 and the Nasdaq 100 that you can buy. So Invesco has created the QQQ. You may have heard of that ticker symbol, which is a mirror of the top 100 stocks that are in the Nasdaq. And conversely, if you want to invest in the S&P 500, you can invest in Vanguard's VOO, VOO, which is Vanguard's S&P 500 ETF. It's an ETF that's designed to mirror the S&P 500. So now that you know, let me know in the comments, which one do you plan on investing in? Do you plan on investing in the Nasdaq 100 or the S&P 500, or neither? Let me know in the comments.